joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market performance. Jason, thanks so much for your time this afternoon. So a lot happening, right? We know what's going on. We don't know what's going to come out of Trump's mouth, but we're all just watching very attentively. And for most part of the year, he's been basically dragging Fed Chair Jerome Powell's name in the mud, threatening to fire him and calling for rate cuts. There's been, reports suggesting that Trump penned a letter to fire Powell, but then he came out saying that that's highly unlikely to happen. How do we make sense of it all? I mean, it does still raise those concerns about the independence of the Fed, but we are seeing markets really shrugging everything off.
Yes, thanks for having me. Absolutely. I think, to be fair, it would seem that Trump doesn't actually know what he's going to say next either. Look, I mean, around this, there is the one school of thought that he's testing the water to see what market reactions would be should he make a move on Fed Chair Powell. I think if we kind of zoom out a bit here and we look back to Liberation Day and kind of what caused that backtracking from Trump, yes, there were those big equity market moves, but probably more importantly, if you cast your mind back to then and you look at what actually happened on the yields, particularly around the 10-year and the 30-year yield, where we kind of approached 4.5 on the 10-year and 5% on the 30-year. We're kind of at that level now as well, and we did see that spike in volatility yesterday and the spike in the yields and the weakening of the dollar on that initial news flow. So I think if we look at also what Scott Besson said earlier in the week in an interview he gave to Bloomberg, speaking about how important the independence of the Fed is, and it's not just a political ally that is appointed to that position, because if that were to be the case, then they would probably lose the long end of the curve here. And I think these large moves in the yields are problematic when you think of broader fiscal sustainability in the US. And one must remember that, interest payments are the third largest item from an expenditure point of view in the US. And it consumes about 19% of federal revenue at the moment, and that's probably going to reach almost a quarter of federal revenue in a few years' time. So, and then that also squeezes out resources that are available for the likes of infrastructure, healthcare, and the like. So yes, we saw the spike in yields, and I think yes, Trump might be a bit volatile in terms of what he's saying, but they certainly are reacting in the right way when you are seeing these spikes in the yields around the 10 and the 30-year and kind of reining that back in because they do understand that fiscal sustainability is an issue in the US and having these high yields is just it's extremely problematic.
So not much action playing out when it comes to the equity markets, but we are seeing some reaction coming out from the dollar as well as the bond markets. And just on the issue around rate cuts then, Jason, we had inflation numbers out this week, consumer prices picking up pace, edging further away from the Fed's 2% target. And we haven't even, seen the full impact of the tariffs yet. So I guess risks to inflation are still to the upside. On the other hand, we still have the labor market pretty resilient. We do have the Fed meeting in the next, 2 weeks or so. With that being said, and the data that we have on the table, I guess it's safe to say that we're in for another pause.
Absolutely. And I think if we also look back to the Fed minutes that were released a week or so ago, they're very much of the wait and see approach. If we look at commentary out of the big banks over the last 2 days in the US, it's giving a good insight into consumer health there as well. And they're specifically citing that the consumer seems to be okay. Credit card delinquencies seem to be in line with the expectations. So to your point, you've got the labor market and the economy seems to be doing okay, but you do have this skew to the upside from a CPI perspective. And yes, we have yet to see the full tariff impact. I mean, over the last 4 or 5 months, we did have a 90-day pause. Yes, there was the 10% baseline, which everyone is paying. And yes, we are seeing an acceleration in CPI in the US. So you think of the Fed's dual mandate, full employment, as well as a 2% interest rate target. It is very difficult to see at what point or actual justification for cutting interest rates in the US at this moment in time. Maybe further down the line, September or November. But I agree, it's extremely unlikely that we will be seeing a rate cut here in July.
Uncertain times call for uncertain measures because, I mean, even those expectations when it comes to Fed rate cuts, in the beginning of the year, we were expecting rate cuts from this month, from July. And now here we are, and most of the expectations are moving towards the end of the third quarter, which is September. So we can only cross fingers and toes that actually happens. I want us to move over to some earnings. You mentioned what we saw out of the banking sector. I want us to touch on TSMC out with numbers this morning, and of course benefiting from that AI boom, Jason, which pushed both its revenue and earnings to all-time highs. This comes as no surprise, of course, being the main manufacturer for NVIDIA chips.
Absolutely. Look, this is, I think, the 16th quarter in a row that they have beaten expectations. It does speak to the demand for what they are supplying, as well as maybe being a bit on the conservative side from a guidance perspective. Mm-hmm. But I mean, it's a fantastic set of numbers. I mean, net income up 61% year on year, 10% on the quarter. Good gross margins, almost at 60%, operating margins of about 50%. And it just comes back down to, look, it's an exceptionally high quality company. Despite all the tariff uncertainty, they have just beaten, and now they've also raised guidance further. And yes, we have seen this AI demand come through, but according to them, it's continuing to accelerate. And the company's saying demand from AI is just getting stronger and stronger. And I think we'll get into it a bit later on ASML, but unlike that, both reported numbers and tone are positive. So it essentially boosts confidence overall for the entire AI cohort.
And quickly, before we go into clips, let's get into AI, because it was really ASML, that is. It was really interesting to see the commentary, the differing commentary between both companies, where we have TSMC quite positive when it comes to their guidance, and on the other side, ASML not so confident.
Yes, absolutely. And I think ASML is unique in that they're seeing a lot of impact, particularly around the US customers delaying orders due to these tariff concerns. So until we get some certainty over, given that it is a European-based company, we get some more information around trade deals with the EU and the US. That's definitely having a large impact on their guidance for the next 2 years.
And I thought as much. I thought it would be, that EU-US deal that still hangs in the balance, really just affecting the company. All right, let's hit pause on the conversation then. Jason, before we move on to your stock pick, let's take a moment to touch on what your industry peers are finding interesting.
I've actually chosen a company that actually provide these restaurants with their food, namely Bidcorp. Also, one of these highly, great quality companies. Always wanted the opportunity to buy in, but it seemed to be on the higher side. So, for the listeners out there, what I love about Bidcorp is it's a well-diverse company. I mean, to buy into a Bidcorp, you're not buying into a South African company or a pure US company. When you look at their splits in terms of revenue, it's pretty much a third Europe, it is a third Australia and the UK, and then a third, we're talking about emerging markets. So you've got such a great diversified company that's trading definitely with the recent pullback in the share price is giving us an opportunity to buy a company that's usually trading at higher multiples at, I think, quite decent levels. So yeah, going for Bidcorp.
They're downgrading the outlook for 2026, and they're conservative. They're a Dutch company. They're not a Zuckerberg or a Jensen Wang or anybody. Have you ever seen an excited Costco? They're very conservative in their outlook. So, for that reason, correctly so, they downgrade where they're going to go in 2026. It doesn't mean that necessarily it's going to be tough, but they don't want to put their necks out there. So the market hurt them, not because of the incredible results that they have produced and also because of their increasing order book, but rather because they've downgraded 2026 sales and so on.
So we touched on ASML, so perhaps let's get your thoughts around Bidcorp.
Yeah, Bidcorp, super high quality business due to the high incremental returns of adding more customers to existing routes. It is something we have owned in size before. We're currently not shareholders at the moment due to somewhat of a stretched valuation at this point in time.
Okay, and then let's get your stock pick. Where are you seeing opportunity?
Yeah, our stock pick is Premier Group. Shares done very well over the last years. It's re-rated closer to peers. Management has guided for medium-term earnings per share growth of 20% plus per annum, but neither the market nor the sell side seems to believe them. In our view, there is still good runway of internal capex projects, offering highly attractive rates of return, as well as the potential for accretive M&A. If management does hit their guidance, which we believe they can, you're looking at a valuation of about 8 to 9 times earnings in 2 years versus their peers in the mid-teens.
All right, Jason, let's leave it there. Thanks so much for your time and sharing your insights. That was Jason Horn from Steyn Capital Management.